Thank you very much, Peter, and thank you also for inviting us here to Liechtenstein. It's a pleasure to be here on site. And I believe it's a premiere that we do the presentation in English. So also thank you for Liechtenstein accepting us in giving this presentation in English. Let me start with a few words on my person. So my background is basically half of my life I spent my time in banking on the equity capital market side and in mergers and acquisitions in London and Frankfurt, focusing on financial technology. The rest of my professional life, the other 20 years in consulting with different houses and boutiques, and now managing financial technology for Netcetera. I would like to start a little bit differently, not diving directly into the technology, and that's why we also chose that setup with Thomas as a co-speaker, but starting with market perception, because I think if we talk about digital assets and tokenization, it's very important that we think about what keeps a banker today awake at night. And if we go to the next slide, it's all about net new money. And if you look, and that's an interesting study from KPMG, and which are doing this study for the last 10 years. And what you can see here, the median of net new money is basically 20 basis points in the last year, which really shows that it is a hard fight to acquire client assets and to fuel the private banking with net new money. And so the question also primarily is how do we achieve and leverage net new money and the assets under management from a banker's perspective. And I think here, and that is a baseline, a good entry position to talk about digital assets, because we believe digital assets in the futures and crypto in the future and crypto assets will be a good leverage to increase potential for net new money. Why? And I think it's also, if we look from a country perspective to the next slide, if you look at where Switzerland is positioned, that is also an interesting perspective from a worldwide comparison. Switzerland is still leading the pack for offshore wealth with $2.3 trillion US dollars under management. And then coming Hong Kong and Singapore, I think it is more interesting if you look at the compound annual growth rates. And the Asian hub is challenging very much Switzerland here, with Switzerland growing 3%, and the others are between 10 and 11%. So not only net new money is scarce in terms of getting that onto the books and to be managed, but also Switzerland and Europe is challenged by Asian wealth hubs, and that is going to continue. So even more here, the question is, do we have a technology perspective to enrich net new money through digital assets and tokenization? So if you go to the next slide, I want to open up a bit the numbers game, not only looking at historic data, but also opening up the perspective in where we could possibly land in a couple of years from now. If you look at numbers that are in the Credit Suisse Wealth Management Report, and also what Zeba Bank also analyzed and showed, you can look at it on a financial wealth perspective. And today, in 2019, 206 trillion US dollars before Corona, and non-financial wealth, 127 trillion dollars. So that's going to grow a double-digit pace. That's the estimation. That's the forecast. So we would possibly land in 2024 on around 450 trillion dollars global wealth, non-financial and financial wealth. Now, that's if you look at the assets today, digitized assets, or in terms of digital assets and tokenized assets, are in the quantile. Right? You have, if you look at cryptocurrencies as a prominent example, you will see about $500 billion in cryptos. That's close to nothing if you look at the big numbers. But if you just assume that in 5 years' time we will land at a 1% market share of digital assets, we are addressing a potential market of $4.15 trillion US dollars, potentially for digital assets. And Thomas is going to look into it a bit more, and in the detailed perspective, what assets are digitizable, but we're not only looking at financial wealth, but also on non-financial wealth, meaning real estate collectibles, but also, and that's an important point, so we want to address is how can you leverage by tokenization, by securitizing them into tokens, how can you leverage illiquid assets to liquidity, meaning also private equity and other private debts, for example, are potential assets we're looking on, and especially also from a perspective of alternative investments. So that's the potential, and if we go a bit more on the client side, and I think that is also, if you combine a client perspective, next slide please, thank you. If you see what are expectations of clients in the wealth management sector, and if you combine it also with where the money will grow from a hub perspective in Asia. Firstly, if you address Swiss clients, and that's a very interesting number here, 38% of Swiss high net worth individual clients are very satisfied with their bank. That's a study found remarkable by LGT in 2018. On the other hand, if you look at European banking clients, 54% would trust a big technology company. Obviously, there's a big part here in retail banking, but also if you assume that wealth management is pretty much a generation business, we will see truly a shift in the next generation taking over the wealth and being technology affirmative and using those technologies. So it's not only a market potential, but it's also driven by the client side. And if you look at the discussions, also and the words put out by traditional banks, that the association also that crypto is very much on also governed by money laundering activities or illicit. If you look at the pure numbers, interesting here from May 2019, Review of Financial Studies, 76 billion value of cryptocurrency transactions were associated with illicit activity. That's significantly less as the yearly drug traffic money just in the US. So it's not as big as assumed. There's fear here, and I think the regulators also did a great job in regulating cryptocurrencies and to be regulated digital assets. So there's a lot of trust here being built by the regulators and having anti-money laundering rules applied, and also secureness from a legal perspective for those digital assets. If we move forward, what we see as crypto options for banks, as I already pointed out, it's a good leverage to generate net new money, because net new money is substantially harder to come by, especially in Switzerland. If you look at the growth numbers for the private banks there, we have increased competition, shrinking margins, also from other global hubs that not only address Asian money from Asia, but also address European wealth and try to attract that. And substantially, not only in retail, what we've seen for years, decline in Germany, but specifically in wealth management, with a change in generation, we have shifting expectation on client experience. And also continued pressure from regulation and traditional financial instruments. So there is a substantial overhead if you design derivative instruments already. And we have a much clearer path now if we look forward on secure token offerings, for example, in the digital asset side. So there's also substantial improvements besides the continued pressure from on the traditional asset side. We move forward. Thank you. And I spoke already on regarding the regulators. I think worth mentioning here is the FINMA, which already in 2018 had a split in definition, so to speak, after the worldwide spread of, say, the ICOs, the initial coin offerings, which brought the regulators to the table. So in 2019, we had differentiation by FINMA and asset tokens, utility tokens, and payment tokens. I think that's important. If and Thomas will also look at those definitions and give you a bit more of an insight here. The BaFin had a slightly different definition here and defining all cryptocurrencies as financial instruments, which then are governed by BaFin rule. I think the interesting information bits here to mention is that already in the first quarter of 2019, German secure token offering in the real estate area for real estate around 260 million by a Berlin fund was certified by BaFin and went public, and the book building was 100% completed and was floated already in 2019. So that was also a good sign for the market. An object followed later in the beginning of 2020 in Switzerland, also a corporate real estate object. Liechtenstein discussed in the legislative 2019 the launch of the blockchain law, and it's now in law actively since beginning of 2020, also providing a baseline for all token-based fundraising. And that's primarily important because if you look at from a regulatory legal perspective, alternative investment funds were the first to adapt cryptocurrencies and are live with that from a regulated perspective. And also the SEC is very closely looking at ETF structures on cryptocurrencies. And that is also a building block if we go further than into the digital asset side. Estonia has a slightly different view on assets, and Estonia is one of the countries that began very early in adoption of DLT and blockchain technology in crypto assets already after the financial crisis in 2008. So they were European early movers, also to spur the market there and very quickly to open up participation rights. The SEC has a very straight view on ICOs and also on the SDOs, and applying the Howey test here, one of the first SEC rulings from the beginning of the last century, where you could where the investment is regarded on a specific rule set and is applying that. And Wyoming was one of the first states supporting the ICOs with specific regulations. So there's a lot of movement, and I think that's also important if you see what is how the digital assets work and are structured and how tokenization works. If you look specifically at investors, not only private investors but institutional investors, that is foremost important that we have a clear regulatory perspective and rules and regulations. So that would finish my introduction. Just to give you, from a banker's perspective, what we think keeps bankers awake and driven into potentially into digitalization and digital assets. And maybe there's a crypto paradigm, a new one around the corner, and opening up the new money perspective for banks. Because if assets are digitizable, everything is bankable. If you look at non-financial assets as a prominent example of today, roughly 100 trillion US dollars, there's a lot of potential not only regarding collectibles, but very much also in the real estate area, and opening that up for a wider audience of investors. I mean, just a final remark, there was an interesting benchmark up in the press just recently. I think that's also from an investor perspective very important. That was still the key argument for alternative investment funds and cryptocurrencies. where the position is that crypto is very uncorrelated to any other assets, so potentially attractive to enhance existing portfolios or hedge specific investment risk. That is also true for, at least now, for STOs that happened in the US, which now, if you look at the numbers, are just slightly correlated with the market index, especially if you look at the past corona times. So there is a strong potential here, not also opening up wider assets or more assets, but also hedging potential and portfolio differentiation potential, not only for crypto, but very much for digital assets. So, thank you. Are there any questions?
Not. So then Thomas can keep on with his presentation.
Sure. Happy to take over. So yeah, I'm Tomáš Kovačič, CEO of Securities Grid. So Securities Grid, we're a multidisciplinary team with backgrounds from capital markets, law and compliance, and of course our biggest strength, we're DLT enterprise experts. So when it comes to engineering and DLT, we have a lot of expertise on that area. So we're originally founded in London, but because of our really great investor, Netcetera Group, since we're part of the portfolio, we also have a strong presence in Zurich just as well. And what we're building is a B2 bank to B white label tokenization platform. So we're in the business of helping financial institutions, banks especially, to innovate for their clients. That's just a little bit about ourselves. And to start with, I would go into the first topic. So Peter, if you can switch over to the next slide. I would do just a brief introduction into asset tokenization. So the first thing that I'll talk about is the ecosystem of asset tokenization. What is it? Then I'll compare that to the legacy technology stack of capital markets, and then I'll talk briefly about how these two ecosystems are converging. So what is asset tokenization? This is representing real world assets on a DLT network. And so you're going to find that I'm using the term DLT network during this talk. So a DLT network or a blockchain network can be used interchangeably. I just prefer to use the term DLT network because it's a more general term, because it also includes not just the public chains, but also the technology that's lately very prominent, which enables corporations to deploy their private instance of a DLT network. So I'm going to stick to that term during my talk. So what is then a token? So essentially, how you can think of a token? Token is a unit of account on a DLT network, and tokens are units that can be programmed with very specific transaction rules. So somebody that knows how to produce such transaction rules, and I'll touch on this a little bit further on. What you can build in is essentially our rules of how tokens are able to change hands between different accounts, and what you're able to achieve with such transaction mechanisms, that you're able to program in compliance rules and even delivery versus payment milestones and other rules as well. So if you compare this ecosystem of asset tokenization to the legacy capital markets technology stack, the legacy systems are pretty much large, centralized proprietary systems. And banks always rely on institutions that are bigger than theirs and have a systemic importance to be able to clear transactions among them. And of course, this yields a hierarchical model. It creates a tree-like model where you have a really big important systemic institution on the bottom of the tree, and then you have multiple layers of systemic institutions that on the end you have the actual banks that are servicing the end clients. It really depends on the jurisdiction, how many levels there are. But essentially, this tree model drives up the prices as you progress towards the top. And on my next slide, I'm going to go, Peter, if you switch over to the next slide, thank you. On my next slide, I'm just going to go briefly into how these two ecosystems are converging. So they're converging in a way that the capital markets ecosystem it's borrowing ideas, of course, from the asset tokenization ecosystem. So essentially it's through the use of smart contracts. These are the transactional execution mechanisms that actually power the transactions between tokens that I've mentioned just a tiny bit earlier. And it's the utilization of these smart contracts to create compliant tokens that can represent and model out real-world assets. So next up, how these assets are also converging is that what we're witnessing right now is the deployment of permissioned institutional-grade DLT networks. And another aspect of it is that we're witnessing also standardization. We're living in an age where now we have an entire suite of so-called security token standards called ERC 1400. And with standardization, you can achieve true interoperability between different institutions. So on my next slide, Peter, if you can switch over, I'm just going to go into how does it work, and the best way to explain in terms of how does it all work and come together, I'm going to talk about the capabilities of the distributed ledger technology. So first off, a distributed ledger technology network, it enables very precise tracking of digital assets in a distributed network. So essentially you have a network of database computers, and on this network of computers that can span across multiple institutions, you're able to very precisely track each individual unit that represents an asset, of course. Then another capability is that every transaction is coupled with user's identity. That's an important aspect that this technology also brings to the table. So for every transaction, you're able to, if you have, of course, appropriate permission, you're able to see which user with which identity participated in a particular transaction. You're able to see the full history and the audit log of such transactions. Perhaps the biggest benefit is that all network participants, so everybody that's part of a DLT network, either a public one or a closed one, they're able to see a consolidated ledger state for every transaction. So every transaction that happens, you're able to see the state that the global ledger is in. So that's perhaps the biggest added benefit. Next up, previously I touched on smart contracts as transaction execution mechanisms. So that's another capability. A smart contract. So essentially, this is a transaction execution mechanism that's also distributed across the entire network. And if you have a similar transaction execution mechanism as everybody else, you're able to produce the same transactions and you're able to mutate the same global ledger in the same way. That's an important part of this technology stack as well. And then lastly, the last capability is, of course, that you're able to take smart contracts and using smart contracts, you're able to create tokens. So these are the aforementioned units of accounts, and you're able to support very complex transaction rules. And I'll explain those via an example, because with these transaction rules, you're able to achieve securities law compliance and other aspects as well. Now, on my next slide, Peter, if you can switch over. I'm going to walk everybody through an example so that previously I talked about these capabilities in a theoretical way. I'm going to go now into an example. So let's design a private share token. So we're going to create a new digital asset, and we're going to use this token technology to create a new token that's going to represent a share in a privately held company in Switzerland. So the first step is obviously that you create a token. The second step would be that you're able to link the token completely immutably to the underlying asset representation and the legal documentation that essentially tells what's actually encompassed, what rights does a particular shareholder have if they hold a particular token. And then we can start building in building in permissions and restrictions into such a token to achieve the compliance aspects. So first things you can add, so here from points 3 to 7, here are just a couple of examples what you're able to build into a token. So on point number 3, we can add permissions to a particular authorized party to be able to increase or decrease supply of a token, right? So if you want to, there has to be a particular entity that is authorized to be able to increase supply of a token, which would mean in the context of a privately held company, to increase the capitalization of the company, of course. So there's the board secretary. That's pretty much the only person that is able to authorize such a transaction. So next up, we can even build in whitelists for KYC, AML, sanctions, screening, accreditation whitelists, whatever have you, so that only a particular set of users are able to help that token, right? So we're not creating a bearer instrument here. We're tying it to specific user identity. So that's how you can achieve compliance on those aspects. And then you can put in additional rules in it. When it comes to private companies, private shares usually have what they have built in are preemption rights for either primary or secondary market transactions. You can do both. You can put in transfer restrictions, and here it's a really good use case for the smart contracts. Really cover this use case well, especially when it comes to lifting transfer restrictions, because what you're able to do is you can employ a multi-signature mechanism where a buyer and seller are able to propose a transaction between the token, and then they have to wait for the third signature, which is the board secretary's signature, to lift the transfer restriction if such a share has that built into them. And you can go on. You can build in anti-accumulation rules or whatever have you. So hopefully that paints, adds enough color so that you can get a better understanding how does it all work and how does it all come together. And Peter, on my next slide, what I'm going to go into is how far did we come? So in the past, it's a fairly young ecosystem because the first tokenized financial instrument was actually released back in 2017 and was pioneered. To my knowledge, there could have been some security token offerings even prior to that, but to the best of my knowledge, my research, Blockchain Capital was the first one that they released a tokenized LP share. So they didn't tokenize their underlying assets, but they tokenized the fund. They tokenized the LP shares, so the investor in the fund, they got an actual security token that could be tradable directly on the blockchain. So that's the past. That's something that kicked things off in the present. So we have the aforementioned. We now have a full ERC 1400 security standards token suite, which means that this is an open standard. So everybody can participate in extending such a standard, add amendments to it. And of course, also these standards are also completely openly implemented. So in theory, a security token issuer can take this code and launch a token by themselves, right? So this is, but of course, usually they lack some expertise. So that's a business opportunity for a lot of entities that are participating in this ecosystem. And so also we're seeing in Switzerland, we're seeing the first blockchain IPO approved by FINMA in Q1 this year. And of course, so Niels previously also spoke about the Blockchain Act in Liechtenstein, which is now opening doors to a whole lot more supply of security token offerings. And here's perhaps just a speculation of what the future holds. So most of the STOs that are actually happening, they're being done on public blockchains using the standards that I've previously mentioned. But what's coming up is actually we're in the phase of deployment of permission chains that are actually deployed by corporates among them. And they're going to compete with public chains moving forward, right? So I would just mention just a few projects in this area. So Deutsche Börse is working on their permission network. They're codenaming it DSD, the Decentralized Securities Depository. In Switzerland, a very prominent project is SDX, so a subsidiary of Six Group that's also working on their own permission technology. In the EU, there's a CSD called KDD. they're launching their platform, codenamed KDD Digital. And we were very proud that we were actually part of that story. We were the actual implementers of such network technology. And overseas, what you're seeing is the formation of one of the largest banking consortia, which is called Finality, with their utility settlement coin. And this network, initially, what it's going to facilitate is FX transactions, but moving forward, it's also going to, at least that's what the roadmap says, it's also going to support native digital assets just as well. So that's something that the future holds. Peter, on my next slide, I'm going to touch now on, so when it comes to the tokenization ecosystem, I'm going to touch just briefly on what value-added services can banks bring to the ecosystem, right? What's in it for them? And I'm just going to mention 4 types of services, and behind every service, there's an obvious revenue stream for a bank just as well. So first off, I'm going to talk about the issuance. So there's a lot of service. So when it comes to the securities token issuance services, this market is right now, it's entirely dominated by consultants and token platforms. So consultants, they approach the issuers and they consult them on how to design a token. They consult them for the production of the legal content and all of that. And then there are the token launch platforms that provide the technological execution to be able to do that. So banks are perfectly positioned to offer both of these services directly to issuers because they already have relationships with equity or debt issuers, and they're able to offer this as a service directly to them. So both the consulting part and the actual technical execution. And not only that, not just that they are able to produce the token launch transaction, but also to offer the lifetime management of the token, which is an extremely valuable service for the issuer. And in my opinion, it's the missing piece of the entire puzzle. And banks are perfectly positioned to offer such services to token issuers. Not only that, but banks are of course also they can also service the issuer to ensure that the actual marketing campaign and the actual primary market sale of a token is completed successfully. There are also some advanced services that a bank can offer, which is of course rebalancing the supply between different blockchains. If a security token offering is deployed in multiple, but let's not go into that. That's perhaps a more an advanced topic that I'm happy to go during the Q&A. So of course, the issuance goes hand in hand with custody services. So custody, a secure custody of tokenized assets, solves the original sin of blockchain technology, which is what happens if you lose your private key. This is, of course, losing your private key. It's a big problem, obviously, when it comes to cryptocurrencies. When it comes to tokenized assets, if you lose your private key, you can still go back to the issuer to issue your new tokens because you have a right to do so. If you haven't designed a token in a way that it's a bearer instrument, right? But still, losing a private key means a ton of trouble down the road, and it provides insecurity. But of course, through custody, all of this goes away. There is an additional added benefit to having your tokenized assets custodied by a bank, which is that you don't have to be a user of the underlying technology, right? So if you have your tokens custodied at a bank, you're just using the banking application as is. You don't even know that it's blockchain in the background, right? So that's another added value when it comes to the custody of tokenized assets. And of course, custody then goes hand in hand with brokerage and trading solutions and services that the bank can also offer. So another important, the last one on this list is, of course, the identity services just as well. So if a security token issuer is onboarding new investors, so it's important for this issuer to, of course, to identify who these investors are, and identity services identifying these users and providing the appropriate signatures that they've been identified by appropriate persons. This is a service that a bank can additionally offer to do such a security token issuer just as well. So on my next slide, Peter, if I may, I'm going to now touch on what assets to tokenize. Of course, there's an overall vision that down the road that pretty much all assets are going to be digitized and the blockchain is going to be a big part of it. But if we look at it today, like what assets does it make sense really to tokenize and digitize today? Here are just a couple of examples. So private shares. So previously I mentioned, if you're tokenizing private shares, I'm going to touch on what are the benefits on that. Private debt, just as well, LP shares and alternative investment funds, and of course, even small to mid-cap public equities. So what is in common across all of these asset classes is that these asset classes are illiquid, and they are actually issued in a paper certificate form, which causes big process problems down the road when you have to transfer them to another entity. So if we would to tokenize these assets, what are the benefits? Of course, the first one is increased transferability. It comes actually from the fact that you're able to digitize and capture really complex transaction rules and streamline them and reduce the costs related to such transactions. That's an immediate benefit. So that's an important benefit and an aspect when it comes to tokenizing these asset classes. You can also, of course, open them if you digitize them, if you tokenize them. You can also open them to a much more wider pool of investors. That's another important benefit. And lastly, all of the transactions with such assets are verifiable, and that's something that's really interesting to regulators, and that's something that's driving the interest of regulators, because every transaction that happens with these assets, they're verifiable. The entities are actually known in a particular transaction, and that's a big added benefit for that as well. But if we then these are the benefits of the issuers, but if we talk about the benefits, what's in it for the banks? So of course, the biggest benefit here is that this opens an entirely new vertical for a bank, because they're able to offer a new digital service to their corporate, generally to their securities issuers customers, right? To their corporate fund customers, whoever they're servicing. Additionally, by tokenizing and digitizing these assets, it also creates an entire new supply of alternative investment opportunities for the bank's investor clients, right? So this is so when it comes to wealth management, private banking, asset management, this generates an entire new supply of securities to be marketed to such investor pools. Additionally, if you're offering this unique new digital service on the market, this also enables you to cross-sell and upsell across your entire portfolio range of services that your bank is offering. And lastly, of course, you show that you're innovative and that you can innovate for your clients, which is a constant pressure in a lot of banks. So, Peter, if you go to my next slide. So here I'm just going to briefly touch on our product. Our product is called the Tokenization Server, and it has and it's a platform. It's a digital securities lifecycle management platform for financial institutions, and it has two sides. So first, there's the infrastructure side, and then there's the white label use case side that I'm going to briefly touch on. On the infrastructure side, what we provide to financial institutions. To a financial institution is managed on-premise, or we can even host it for you, DLT infrastructure, so that a financial institution is able to connect to several DLT networks, execute transactions on such DLT networks, and that they have the independent means to verify that they indeed produced a valid transaction on such a network via a particular DLT protocol. So that's the infrastructure side that's hidden behind the scenes and can be further on integrated, and that's something that Niels is going to touch on the next slide. But before we go into that, not only that we deliver the infrastructure, but we also deliver the white label use cases on top. So far, we've built two applications that directly drive revenues for banks, Number one is, of course, is something that we call the Digital Ownership Management Suite, which is a white label platform for managing digital assets, and we can also then even later on during the discussion, we can even talk about the particular use case of what benefits are for fund managers and for SMEs to manage ownership via this solution. We're going to touch on this with Martin. And of course, the next product is integrated with the first one, and it's a white label investment platform, and that's a platform for forming capital via digital asset offering. So it's a much more simpler product because it allows a bank to onboard investors to a new investment opportunity. It allows investors to subscribe for a new investment opportunity and allocate securities then in token form to them as the campaign closes. So that's the product that we're building. And now I'm going to let Niels to add further color how this all ties together when it comes to the Netcetera's digital banking stack.
Yeah, thank you, Thomas, for describing and giving a clear view on what's in it for banks as a second step from what's driving banks and what are they longing for. And I think if you look at the whole technology, DLT and distributed ledger and tokenization, we're all over now on the innovation path, right? So disruption has already happened. So you see a lot of incumbents or challenger banks or whatever you might call them, and even crypto banks in selected countries. Now, what's important here, and I think why we play this game together very efficiently from our perspective, is that Netcetera has been in the business 24 years in integrating business complex, business-critical application in banks and other industries. And Thomas and Securities Grid as a company has a very innovative product. So if disruption is already happening, what we want to do is really provide existing players, banks, private banks, bigger banks, other players in the financial industry, with a solution that makes that technology from our expertise. 24 years we have been doing business in integration and bringing that to the table and making that technology accessible, B, make it integratable, because we're not, if you look at an incumbent, it has an advantage surely because they can do a greenfield. Most of the banks, and bigger banks, smaller banks, whatever size, have a challenge because they have a complex legacy system. So we're not arguing that you can put something greenfield, but we're here arguing and showing the path to integration and really integrating that to existing legacy stack. And I think that's really momentum here, bringing things together, because it's a quick path to innovation. To the integration, meaning that the banks and our clients then are respectively in the position to really generate the network effects, right? Because in the end, it's really about how to make network money happen and how to participate in the issuance and the custody field, for example. So I think that's a very important thing when it comes to integration. And we provide that in an open manner. On open banking, from open banking aspects. And also, if we talk about business critical integration, what we've done the last 24 years, our second name is payment and security. So that comes together, and that's also a very important point in bringing that to the banks. Thank you.
So currently there is no question in the chat, so let's keep on and go to the talk. Wait, just stop sharing so that we can see all of us. So, and let's just ask Martin, do you have some questions about that?
Yes, of course, I have some questions. And first of all, thanks Niels and Tomas for these interesting insights into technology and the exciting opportunities business-wise. For me, as an innovation guy, this is very interesting because it opens a lot of possibilities to enable new business and improving existing business. So very interesting. And from a use case perspective, I listened very closely to your example, Tomasz, with the private shares token. Perhaps it's a good idea to deep dive a bit more into this specific example and talk about that as a use case. So, is it right, for example, we as Netcetera are such a small medium company that has its own private shares, and the solutions we talked about today, that's really about this tokenization of these assets. And the question is, why should we do that? What are the benefits of doing this?
Sure. Happy to elaborate. So there are many such companies out there that have a very similar case as Netcetera does, right? Perhaps I can even share a story. When we were working with our first institutional client, we were actually during a pilot project, we were actually engaging a company that was once listed on the London Stock Exchange, and since it became private, it still has around 1,000 shareholders, right? So it's either if you have more than 50 shareholders, that means that secondary market transactions then do happen, even though if you're a privately held company. So I'm going to talk about first in terms of like what solutions and what problems can we solve for such companies, and then I can even bring it back to how a bank is able to leverage these solutions and offer it as a service on the market. So if you're a privately held company, how you're actually managing equity in a company, you're using a spreadsheet that counts as your internal shareholder register. Actually, it's multiple sets of spreadsheets. It really depends on the jurisdiction. And then you're issuing these securities in certificate form, right? So you're issuing them paper certificates, either in electronic form or actual paper form, right? So this is how we manage equity. And as soon as you encounter a secondary market transaction, that becomes painful very fast, because you have to scramble to look for the latest version of your shareholder register. Then you have to ask the shareholders to actually, depending again on the jurisdiction, to send you the paper share certificates that are going to be in some jurisdictions actually destroyed, and you're going to issue new paper share certificates. And of course, you have to send them the legal documentation. They have to sign this legal documentation. So it's an entire process and involves multiple people, depending on the company and on how well designed the legal content and how standardized the legal content they have. But there are multiple parties involved. The board secretary has to get involved. If you have transfer restrictions, the board has to actually approve such a transaction. There is an accountant usually involved, because they usually accountants or CFO personnel manage these internal shareholder registers. So these transactions become complex and process heavy really fast. But if you digitize this process, right? If you have a digital tool, we're able to not only issue these securities in pure digital form, but if you have the entire process of a transaction streamlined, you're able to do this much more efficiently. So you're using so in the case of the technology that we build, what you actually do is you access your shareholder management solution via a bank. So it's secure. It's securely stored in the bank. So you're able to log in and you're able to see which transactions were proposed if you're a board secretary, and you're able to then, of course, approve or reject these transactions depending on how the board voted. So able to drastically reduce the costs and the process requirements and time consumed to do such transactions. And then further on, the benefits for the actual bank, of course, is if you've tokenized the company, if you're actually a part of this. This is how your wealth management department can actually start and it kicks off the journey of actually starting to create wealth for the entrepreneurs whose company you just tokenized. So there's multiple layers of value that can be delivered on top of such solutions. And then not only that, since such a service is obviously a relationship-based product. So how we're actually positioning it, that this digital ownership management platform, that it's a new type of an account that a bank can offer to their corporate customer. The same way as they offer bank accounts, now they have a new type of an account to be offered to their corporate customer, and it's a relationship-based product. And during the life cycle of the company, if a company is actually using this product, they can even order more services, because of course they're going to think of your bank as soon as they will decide to increase the capitalization of the company and go for a new funding round, right? So they're going to order more services from the respective equity capital markets department, or if they're raising debt from a debt capital markets department, and they're going to be ordering more services during the lifetime and just generating more business for the bank that's actually servicing them.
We have here a question. Thomas, what's the business model for this? You pay this per transaction, per token, or do we have there a license for institution? No.
Yeah, so it's a B2B to B business model. So we never service issuers directly. So a bank, we essentially charge a license. So we essentially sell software licenses to banks, and that's the business model behind our product.
Okay, and another question: who would audit a digitization platform? Does such an application need to be audited at all on FinTech?
Yeah, so obviously the implementation of the security token standard needs to be audited, and there are several auditors that actually provide that. So in Switzerland, PwC has the most, in our opinion, has far the most prominent and far the most reputable non-financial audit service. They have a team of so PwC actually acquired a company which is a team of security and technology auditors that audit the underlying smart contracts that power such a platform.
If we assume that we address banks with the solutions, banks are regulated under FINMA and need to manage the operational risk, so that is also covered if we address banks as our clients with that solution.
Yeah.
And back to the audit, are there standards for the audit certifications?
There's actually not a standard, but essentially, as whoever produces the technology approaches the auditor, it describes to the auditor what do they actually, what's the intended purpose of the smart contract, what is it supposed to do, and then they check against the rules that you provided. But actually, as a technology provider, we're not actually creating these rules. These are parts of the standard. So you just produce the standards to the auditor, and you just say, "Here's my implementation of the standard," and then they audit your implementation essentially. So so hopefully that answers that question.
So let me further discuss the use case with you, Tomáš. And now you explain me very well why I should tokenize these private shares. Now let's further talk about what's the bank's role in this game. And you mentioned issuance as one of these topics where the bank can play a role. Can you explain me a little bit longer what can the bank do? What is the bank's role in this game, and how can they help us bridging with this technology, building this business in this topic?
Yeah, sure, absolutely. So issuance, in my opinion, having been part of this ecosystem, is currently still a missing piece in the ecosystem. So what's currently actually so how this ecosystem currently looks like, specifically to this part of issuance, is that this is dominated by these token issuance platforms. and how they're positioning themselves as just pure technology providers, and they go directly to issuers, right? So in terms of if anything goes wrong, pretty much the issuer carries all the liabilities. So one such liability is, let's say that pretty much a shareholder loses their private key, and then they go back to the issuer and say, hey, I'm still the shareholder, just give me the digital representation. So I lost the digital representation, but I'm still a shareholder. So please reissue this back to me. So of course, it really depends if that platform is still alive and it's still there, right? So of course, they have business continuity plans, right? In terms of, hey, if we go bust, we're going to just give you the technology so you can pretty much then operate these smart contracts yourself. But not a lot of issuers are actually technical experts that can do that. So then they have to go on the market and seek, engineers who can do the quick fix, right? And they also issuers, that what they also have to do, right? They also have to retain control of the so-called master key. That's the key that controls the entire token, right? So, for example, the master key is the one that can authorize the reissuance of a particular token. So if somebody lost a token, what you have to do is you have to lock those tokens in that particular account, and you have to reissue them. So all of these services, so banks are perfectly positioned to offer a way better service than these platforms are able to do, because these banks are going to be there forever. They have better business continuity plans, and they can also safekeep this so-called master key and offer a way better service to the actual issuer, right? So the issuer doesn't even have to know. Their experience is that they're using a digital platform through which they can access their shareholder register, through which they can execute corporate actions, through which they can communicate with their shareholders, whatever. And they don't even have to know that there is blockchain, that they're actually interacting with blockchain. They're just managing shares, right? It's just that the token form is just the representation of how a particular asset is issued, right? So that's just to start with. Those are just a couple of benefits that banks can bring to the actual issuer. Does that make sense?
Yeah, maybe adding to that, Martin, to your question, what can banks bring to the table? I think it's the whole road down the liquidity road. We all learn as bankers, it's cool to have a big spread, but you need an ask, right? So you need liquidity. At the end of the day, that's one of the critical issues. If you look at the exchanges right now, you mentioned how much the platforms, right? The critical issue is still where's the liquidity for those digital assets. If you transfer to digital assets, it's not a natural law that from an illiquid asset you transfer automatically to a liquid asset. So liquidity here is a key question. And thankful enough, we have crypto banks now, we have other players coming up, so that's very important. It's also a natural role for banks to play a market maker on an exchange or whatever, however those tokens are exchanged on the markets. I think that's important.
I would just add to what Neil said. As soon as the banks are going to start entering this ecosystem, that's where the really interesting stuff is going to start to happen, right? Because then you're going to see both the supply and the demand side to be in balance. Because right now you have a ton of supply, but then you have a limited investor base. But as soon as banks start plugging themselves into this ecosystem, they also bring in their wealth management, their private banking departments with them. And that's where you start getting also investors to invest in this asset class. And then this is how you can really start bringing the true balance between both the supply and the demand side of this market.
We have another question from the chat. What kind of front end is used to access the DFT network? Is that being integrated into a bank's own front end for key management, onboarding, and such things?
So that's an excellent question. So we have I'll just add a little bit of color before I answer it. So we have a layered approach to our technology. So we actually build it the same way as the same way as actually core banking solutions do, because they also have a layered approach to technology just as well. And on the bottom layer, you have the DLT infrastructure. That's where the hardware security module for secure custody comes in. That's where the managed nodes come in, and that's where the smart contracts come in. On top of this DLT infrastructure layer, this is actually from the user, if a programmer wants to access this infrastructure, they have a full API available. So we also offer a well-documented API so that they're able to actually produce transactions, create tokens, configure them, all of this, and they're able to do this via an API. So this API can be actually used to be able to integrate into their existing applications that a bank is currently using. Then on top of this API layer, this is where our white label use cases come in. So a bank can pretty much choose to just use just the pure API, where then just an infrastructure provider, or they can also use the white label applications that we build on top of the API layer. So essentially, when we were building the API layer, one of the first users was ourselves, right? Because then that's what sits on top, and that's where. But when it comes to integrating with the entire ecosystem, I would hand it over to Niels, because he can add perhaps further color in terms of how we can, of how together Securities Grid and Netcetera can take care that this is a fully integrated solution with its entire digital banking stack.
Yeah, thank you, Thomas. I think that's a very important question again, because it enables access for the clients of the bank to the platform. That's one important point. So we provide, in the digital banking stack, we provide those layers, we provide the user interfaces, we support the banks in doing that. And reference is that we do mobile banking for 60 banks in Switzerland. And I think that's also important. If you mobile first strategy, if you want to have it on your mobile phone, access the custody of digital assets on the mobile phone, we can make it happen. Right? It's also the integration interface. It's the leverage in regards to if you look a little bit deeper on the custody side, if you look at cards, for example, the card management and the custody with the card management. And when you talk about cards and accessibility, it's also about security. Right? What secure methods of authentications do you have? What know your clients and onboarding facilities do you have? So we bring it all together in that stack and enable our clients to do this together with the security grid solution. Does that answer the question? Thank you.
Excellent. So you both mentioned, Mark mentioned onboarding, Unix mentioned onboarding. I connect this also with the stuff Thomas mentioned about identity and how you detect identities, how do you identify users where you want to do these transactions, and again, what could be the part of the bank in this way?
Yeah, sure. So what we provide is actually integration with the identity technology providers that are out there. So perhaps the most prominent identity technology provider on the DACH region market is ID Now, and we provide an integration when it comes to that. So I'm not sure if you're familiar with ID Now, but ID Now is just a really simple piece of software that as soon as a new investor in a particular investment opportunity wants to onboard himself, they of course have to go through the process of verifying that it's actually them, right? So that they can go through a video identification process or a pure picture-based one. It really depends on the jurisdictional requirements. So we then just take the information that somebody was appropriately identified and tied it to their newly created digital identity. So that digital identity can be tied to a custodial account that's held at a bank, or it can be identified to their DLT-based wallet. So those are the options. Those are the options that we have in support. And how a bank can actually add value to that is that ID Now, for example, they have an option where or other technology providers. I'm just using ID now as an example. A bank has pretty much the option to either rely on third-party agents that are licensed to do identification, or they can use their own agents. So their agents are actually using the software, just using the software to identify a user and then tie it to their digital identity. So hopefully that answers the question that just came in.
Yeah, definitely, it answers the question perfectly. Adding to this question, so the answer is we work, or you work, or the ability or the benefit that the bank brings in is that we work with identified users. And you mentioned that we also integrate, for example, Swisscom services on the digital banking stack, where we have various identity providers that can collaborate to benefit of these identity services. But I believe this identity is very important when it then comes to store the transactions in the distributed ledger. And probably this has to do with know your customer, anti-money laundering. Can you elaborate quickly on that one? Because it's so important to have this identity for doing the transaction afterwards.
Yeah, so that's why trusted third parties are needed in this entire ecosystem, and that's something that also the standards introduce. So the original vision of the DLT ecosystem was that there's not going to be that everything's going to be peer to peer, and everything's going to and that there's not going to be a single intermediary between two different parties that want to transact. That's obviously not the case. Even the authors of this ERC 1400 standard, they were smart enough to actually introduce trusted third parties into the whole ecosystem. And so because how when it comes to the ERC 1400 token standard, actually trusted third parties, they co-sign all the transactions, right? And trusted third parties are there pretty much to also identify the users for compliance sake, right? So that's the main service that they're able to provide here is, of course, tie it to use whatever means are available. So various different identification solution providers such as Swisscom, such as ID Now, whatever have you, taking that information and linking it to the digital identity that they've created for the user, either a custodial account for it or some digital identity that the user brought to them if they have their own non-custodial wallet, right? So linking these two pieces of information together and offering that as a service to issuers so that they can achieve compliance, that's the key. That's another key service that the banks are able to offer to this ecosystem. Make sense?
And maybe adding to it, I think you all remember the slide where I showed the leader of the banking in terms of offshore wealth, right? And the Swiss, but also the Switzerland, but also the competitors coming closely by in the future, right? If you look at custody as an asset, if you have the custody for digital assets, you will own also the client, right? It's not only from a front office and user experience perspective, but furthermore, in the future of digital assets, if you own the custody of those assets, you own the client relationship. And I think that's what the agents play very intelligently. The services are specifically in China, but we have a good pole position here. We should use that and entirely offer the value chain from a custody perspective, identity perspective, and bring the Swissness in.
Yeah, we have here another question. Which role would you want the SDX to play in this ecosystem?
Perhaps I can tackle that question. So how SDX is actually positioning themselves is so when it comes to CSDs or exchanges, right? It really depends on the jurisdiction. So the SIX group in Switzerland, it's of course it's CSD and exchange under the same corporate group, right? And how SDX is actually positioning themselves as so it's natural for such corporates to position themselves as network operators. So what they're going to be in the business of they're going to be in the business of deploying their own permission network and use that as a successor to the to the regulated financial markets infrastructure. But it's going to be a different piece of technology used in the background. So they're going to be using a permission DLT network to clear transactions among their systemic members. So that's how they're positioning themselves, and that's also how one of our first clients, KDD, is positioning themselves, essentially as a network operator, right? So they're going from this centralized database operator of a proprietary system. They're now positioning themselves as somebody that's going to operate a network and provide appropriate governance to such a network, since it's a closed loop system. So hopefully that answers the question of the gentleman.
Yeah, another question from the chat. How is the real-world asset secured against double spending? In the private held Netcetera shares case, what stops me from reselling my shares against off-chain?
Against double spending. Yeah, so I mean, what you're okay? I think I understand the question now. I had to just reread it. So, what stops you from actually doing that from actually doing that off chain is the fact that you're given a digital token to be able to transact with it, right? But if you want to take that off chain, if you just are pretty much just sold your securities, if you have those rights, and that you just notify the company that another person now has such securities, obviously the issuer still has the appropriate permissions and the technology means to mark that as an additional transaction on the actual shareholder register, right? So it's pretty much the same means that are used today by securities issuers. So I mean there's no way that somebody would be able to double spend in such fashion. Does that make sense?
I think so. What I can quickly add to the question and come back to the issuing topic, right? So just a basic question would be, if I have such a Netcetera share and I want to issue that one on a DLT, do I, for example, have to hand it in to a bank? The bank will, for me, issue this token on the DLT, and then I possess the token, but no longer the original share.
If you want to do a conversion, that's the. Sorry, am I muted, or was I muted for when I started answering that question, or did you guys hear me? Okay, so yeah, that would be the process, right? So pretty much whoever's servicing the issuer can also offer this as additional service. So as soon as your certificate arrives, you get the digital securities in return, and that would be pretty much the process of how a conversion between a Namen Aktien certificate to a digital token would take place.
And if you think that further, you can even think in wallet technologies, right? If you put it into wallet technology, you can think about things we are leading the pack with, like 3DS Secure, right? Where you secure those transactions between cardholders, and all those things are possibly there to secure those transactions.
Yes. I have a further question. Probably that's a tough one, but I have to ask it. If I have to collaborate with the bank and such institutions, why shouldn't we use this distributed ledger technology, and why not just bringing our own database and algorithms on top of it? Because we can do it on our own and control everything, and I believe there are benefits in it too, but why should we deploy all that topics on the distributed ledger technology?
Sure. So the main answer to that would be interoperability. That's one of the main benefits of this technology stack in general, right? Because now financial institutions are able to interoperate with each other and just create more and create more business among themselves, right? And that's pretty much the that's one of the main added benefits. Because how you can also think about distributed ledger technology, it's a database. It's a database that's been built in 2018, 2017, opposed to the 80s. So it's a new database technology that has interoperability with other databases that can be managed by other institutions. And now you have an explicit protocol on how you're able to interoperate with these databases. You have an explicit protocol on how you're able to exchange transactions, right? So interoperability here is key, because when speaking of the permission chain world, right, you can not only just use that to exchange financial transactions, but you can also exchange data multilaterally, right? So now three banks can communicate with each other and exchange data between themselves. Let's say about shareholder data for organizing a remote AGM, for example. That's a really good use case when it comes to multilateral data exchange, opposed to just exchanging financial transactions. So that would be one of the main benefits. Another one is the fact that all the transactions, right, they're actually produced and proposed to the network are always verifiable. That's an important aspect. So so when it comes to just having like one proprietary system and a database, you're never sure if somebody did a change without appropriate authorization, right? So because it's an island, it's a silo in itself. But with this technology, since you have transactional level database interoperability, you're no longer able to do that. You have to interoperate with others, and you have complete verifiability that if I produce the transactions and others confirmed it and endorsed it, they confirmed and endorsed it with their identity, and that makes it way more secure, transparent, and verifiable.
Okay, thanks so much, Tomasz. Let's quickly talk about the custody part again, because that's an area where I have personal interest as well, or it would be very interesting to have various solutions coming together in this area, because Niels was mentioning the mobile wallet, for example, and if the bank acts as a custodian, I can imagine really cool solutions where we can see such assets like private shares in an overall asset overview in a mobile wallet, and this is a quite bright future. Am I putting the pieces perfectly together?
Yeah, that's an obvious benefit, and this is obviously where banks can add a ton of value, and that's going to be the future. So we're going to be throwing away our private share certificates, and it's going to be replaced by like you've put it. We're going to see that as a line item and under one of the tabs in the mobile banking, and that's going to be it, right? So and you're going to be able to to sleep well, knowing that that's safely custodied at a bank, and that you can 24/7, that you can pretty much, if you decide to liquidate, that you're going to be able to place an order on the market. But then it depends on the counterparty if anybody wants to buy it, right? So these transfers, the cost of that and generally the process of liquidating such assets should go down and should be much more easier down the road. So that's the vision behind it.
I think if you add to that in terms of security aspects, right? If you look at digital custody, there's a lot of discussions around hot and cold storage, and I think wallets, also cards, are very representative for implementing hot and cold storage aspect here, right? And they could not only be attracted to retail clients, but also to our high net worth individual clients. having the digital assets and potentially the net new money that based on those wallets managed by a private bank and represented in a wallet type specifically for high net worth individuals.
We have another question. Do you predict that asset tokens will eventually replace traditional securities?
I would not make that prediction, but the one thing that I would predict is that clearly in a couple of years that you're going to have now another form that a security can take place, and that's going to be just a generally new legal topic for moving forward, right? So because right now you can have, when it comes to house securities, the forms that they can take shape are the following. So number one form is, of course, the certified version of a security, right? So that means that it has paper form. Then you can have certified version of a security in electronic form. That just means that you're using PDF instead of a paper, but it's still considered a certified version. And then you have a so-called dematerialized or uncertified version of a security. That means that it's deposited at a central securities depository in book form. So it's just a database entry. But moving forward, what you're going to have is actually in Switzerland, it's going to be called a DLT uncertified security or DLT unmaterialized security. So meaning that it has the token form and it's going to be in tokenized form. So generally, I would predict that not everything is going to converge really fast to one aspect, but now you're going to have an alternative when it comes to issuers. They're going to think really hard. Hey, in what form do I want to issue my securities? I can issue them in this paper form if I'm old school and if I have investors that don't know even what a computer is. But if they use a mobile phone, I'm going to issue them in token form so that I can have that in digital form and not pay all the CSD fees. So I would predict that this is going to be a situation moving forward. And banks, and this is a great opportunity for pretty much for banks to offer that as a service directly to issuers. This would be my prediction. Niels, do you have yours?
Well, it goes pretty much the same direction. I don't want to repeat, but I can insist on that this is the development that we're going to see, right? It's pretty much, and I think coming back to the future, the bright future of potentially 1% of digital assets in 2024, $4.5 trillion gives drive to that. And I think along that, trying to get that piece of the cake by that technology will drive the market pretty much. And open up the chance for illiquid assets by tokenization, the road down to liquidity. In combination with wallet technologies for end clients, be it a high net worth, ultra high net worth individual or retail client. I thought maybe the last quote from my side, I was pretty much focusing on the private banks. So if you look at also in Central Europe, ING or the German banks, that you pretty much address the retail affluent side, where now the retail clients are educated also by application to be financial literate by multi-goal based applications. So you open up a portfolio scheme, an investment scheme for retail clients. And if you acknowledge that the passive side on the banking side will be dead, right, then the active side is much more in focus. People need to self-sufficiently secure their future. Besides existing pension schemes, I think that also gives a drive, and that also drives the securities market and digitalized assets in that space. Does that answer your question?
Yes, definitely. I'm looking to the watch if you have.
I have just one small question. You talked a lot about the benefits of tokens, of all this digitization of assets. Are there some risks?
Well, eventually there are no chances without risks, right? And managing risks, who's best on the planet in doing this? Maybe if you not follow the headlines, but the core business of the bank is managing this, right? In an environment sense. So I think Banks are naturally in a better position than potentially startup or greenfield incumbents than managing risks. And that's also what we see in terms of compliance ratings with some of the challenger banks. I think there are definite risks, but I think it is how we manage that professionally. And I think there banks are in a better position.
Yeah, I would attest to what Neil said. If we look at the German word for a database, it's called Datenbank, right? So pretty much, that's the position for banks to take, because I think it's time the time is right for banks to enter this ecosystem and add the value in terms of the services that we previously described. Because right now, as said, it's token platforms and it's consultants and it's issuers directly, but there are services that can be added to to this ecosystem that can really drive the whole agenda forward, and banks are perfectly positioned to deliver this.